In the previous video, we looked at how the standalone hammer is a low probability risky trade. So there is a way around that, okay. So the hammer confirming prior support and giving prior price confirmation is a high probability trade setup, although it comes at the cost of reward to risk. Now this is something difficult to understand. I will explain this to you with a chart, but the hammer with a price confirmation is a high probability trade. Okay, now what is price confirmation? Let's look at this chart. Okay, so now this is a weekly chart of ITC. Always look at the time frame whenever you are looking at candle charts. So this is a hammer with price confirmation. Now if you look at this, this is a hammer. Okay, I wouldn't call this candle as hammer because I am uncomfortable with that upper shadow. Remember, the upper shadow represents bearishness. So although it is a hammer technically. If you see, there is a downtrend, the lower shadow is more than twice the height of the real body, but it is not near the upper end of the trading range, the real body. I want the real body to be more up. If you look at this candle, the lower shadow is far longer than the upper shadow, and the real body is nicely above, near the upper end of the trading range. So I am comfortable calling this as a hammer than this. But in any case, both candles are looking like hammers, so that adds to the confirmation. So let's say this is a hammer coming after a downtrend. Lower shadow is more than twice the height of the real body. Small real body, small upper shadow, small real body near upper end of the trading range. Now the problem with this hammer is that it's not confirming any prior support area. Now there is a uptrend here which can't see in this chart, but there is an uptrend here. So there is no prior support area. It's not like there is no prior support area. It's not like the price has gone down and then from here it went up. So that's a support area. In this case, that has not happened. So this is called as a standalone hammer. Now we already discussed the standalone hammer is a low probability risky trade. Probably go back and watch the video again. This is a low probability risky trade. So if I take this trade, there is a risk that the price will go down. But in this case, what I am doing is I am waiting for a price confirmation. Price confirmation means what? Instead of taking a trade here, I wait for one more candle. Okay, in this case there is 1 week. So I wait for 1 week and see what happens. Instead of taking a long position here, I see what happens on the next candle. If it closes above the hammer, if the closing of this candle is above the closing of this candle, then it is called as price confirmation. The price is giving us that confirmation because confirmation on what? Confirmation on our bullish view on the market. So when we see a hammer, we are bullish on the market, and the price, when it closes above the close of the hammer, it is confirming our bullish view. That is why it is called as a price confirmation. Okay, so when we wait for one more candle because we don't have the hammer which is confirming prior support. So when we have this price confirmation, then we take the long position. So instead of buying here, we buy here. But now the problem is our risk has increased. So in this case, our risk was this much. Okay, if we buy here, then our risk is this much. So our risk has increased, but our probability of the trade going up has increased as well. Okay, so when you want to increase the probability of the trade working out, you have to sacrifice on the reward to risk. Now what is reward to risk? See, this is where the bears are sitting. Okay, so if I were to take a trade here, probably my target would be somewhere here because this is where the bears are sitting. I want to exit before that price, before price comes near that level. So probably I would keep my target just under that, and my stop loss would be under the low of the hammer. So that would be my reward, and that's my entry point. So I write entry here, the stop loss here, and this is my profit target. So if I measure this distance between entry and profit, that's my reward. and between the entry and stop loss, that is my risk. So that is my reward to risk ratio. Okay. So always the higher the reward to risk ratio, the better. And we will discuss what is reward to risk ratio later. But just understand that reward to risk, when I am trading, I must take trades which are having a minimum reward to risk ratio of 2 is to 1. This is what my coach Steve Nissen recommends. In most of his coaching programs, I have seen him refer to 2 is to 1, which means our reward should at least be twice relative to the risk that we are taking. I am more comfortable with 2.5 is to 1 because I will tell you the reason why I am comfortable with 2.5 is to 1 later in this course. But if it's 2 is to 1, that is still okay. 2.5 is my preference. Minimum, these are minimum levels, okay? Higher the better. So in this case, this is my reward to risk, which is clearly 2.5, more than 2.5 actually, easily more than 2 is to 1. Now if I take a trade here instead of here, now my reward is this and my risk is this. So my reward to risk ratio has reduced. It has gone below 2 is to 1 because my risk has increased, my reward has gone down. So this is not probably not a good reward to risk trade. So the problem with waiting for price confirmation is that you have to sacrifice on that reward to risk ratio. Okay. So that is a cost of increasing your probability that the trade will work out in your favor. Okay. So see, when you wait for price confirmation, what happens? This bullish confirmation has worked out well for us. The price has gone up aggressively. Okay. Although in reality I would not have taken the trade because the reward to risk was not in our favor. I need a reward to risk of at least 2 is to 1. Okay. So how do you trade a hammer? To summarize everything here, this is just a quick basic way of how to trade the hammer. So first is a standalone hammer, which is a low probability trade. Then you have the hammer which confirms the prior support, which is a medium probability trade. Then you have the standalone hammer which confirms prior support, and you have the price confirmation. So you are taking two confirmations here. A hammer which confirms prior support itself is a very good bullish sign. But then if you wait for one more candle for price confirmation, you are significantly increasing the probability that the trade will work out in your favor. However, that increased probability comes at a cost. What is the cost? The lower reward to risk ratio. Okay. So that's the basic way of how to trade the hammer, and this model of trading applies to all Japanese candlestick patterns. Almost all major Japanese candlestick patterns, we can use this model. The more the confirmations we get from Western signals, the more the East meets the Western signals, the higher the probability that the trade will work out in our favor. Now you might combine all of these kind of pattern with other technical indicators like moving averages, Bollinger Bands, stochastics, RSI. You can do all of that, but the basic things, the price action trading, that doesn't change, that remains the same. So this is the most basic way of trading the hammer. If you combine it with your trading system, because your trading system is anyways using the candlesticks, because the candlesticks are representing the price. So the foundation is Japanese candlesticks. When you combine that with your trading system, probably your trading success rate might go up as well. Okay.